This is Nightly Business Report with Tyler Matheson and Susie Gehring.
No rush. The blue chip Dow Index finishes at a record after Federal Reserve Chair Janet Yellen sticks to her script and makes clear the central bank will keep super low interest rates in place for a while.
Profit delivery FedEx, widely considered a bellwether of economic activity, earned a lot of money last quarter and could be a sign of things to come.
And down to the wire, the battle for independence in Scotland and why the outcome could mean big changes for business. A report tonight from Edinburgh. We have all that and more tonight on Nightly Business Report for Wednesday, September 17th.
Good evening, everyone, and welcome. It was, as Susie just mentioned, another record-setting day on Wall Street, with the Dow and the Dow Transports finishing at fresh all-time highs. The reason? Federal Reserve policymakers decided today to keep interest rates right where they are, near zero, for what it calls a, quote, considerable time. Now, that's the phrase some Fed watchers thought would be dropped from its post-meeting communique, and that, so the thinking went, would have opened the door to higher interest rates sooner. Well, not so fast, said Fed Chair Janet Yellen. The labor market isn't ready for higher rates just yet, and low inflation means those rates can safely stay low for now. On Wall Street, the major averages all shot higher, but closed off the highs of the session. The Dow up about 25 points to that high. NASDAQ up 9, S&P edging back from an historic intraday high this afternoon. It finished just 2 points higher on the day. Prices on 10-year treasuries fell as bond yields jumped to a session peak above 2.6%. They've moved up in the past couple of weeks. And the U.S. dollar gained a little bit of ground, too. Hampton Pearson has more.
Federal Reserve Chair Janet Yellen delivered a shot in the arm to equity markets with the message monetary policymakers still plan to keep key short-term rates at record low levels for, quote, a considerable time, a phrase that had become hotly debated in the markets. The reason, key economic measures remain subpar, including wage growth and long-term unemployment.
I want to emphasize that there is no mechanical interpretation of what the term considerable time means. And as I've said repeatedly, the decisions that the committee makes about what is the appropriate time to begin to raise its target for the federal funds rate will be data dependent.
The Fed expects slower economic growth this year and next, slightly lower unemployment, but little change on inflation. The central bank officially announced it will end its bond buying program before it expires after the next meeting in late October. Mid-2015 remains the most likely timetable for monetary policymakers to start raising rates. The size and pace of those rate hikes will depend on what's happening with the economy.
The federal funds rate will serve as the key rate to communicate the stance of policy. To begin normalization, the committee will raise its target range for the federal funds rate. The committee expects that the effective federal funds rate may vary within the target range and could even move outside of that range on occasion.
As far as the timetable for shrinking the Fed's $4 trillion balance sheet, Fed Chair Yellen says that could take until the end of the decade. For Nightly Business Report, I'm Hampton Pearson in Washington.
Josh Feinman joins us now to talk more about all of this. He's chief economist at Deutsche Asset and Wealth Management. Josh, it just seems like the message from the Fed today was that it's in no hurry to change what's going on with rates. Are policymakers doing the right thing from your point of view?
I think so. I mean, I think they've been singing, from the same hymn book for a while. It's that they're not rushing for the exits, and I think that's appropriate, given that while the economy is making progress, we're better off than we were a few years ago, and I think that progress is likely to continue. We're not where we want to be or need to be. Inflation is still running below target, and we're still shy of full employment. The Fed says, they still see considerable slack in the labor market. I agree. So I just don't see there's any great sense of urgency to start moving quickly or aggressively.
Does the Fed's transparency make it easier or harder for investors?
I think it makes it easier in the sense that, the Fed is pretty clear about what they're trying to achieve. They're trying to get the economy back to full employment and back to price stability. So it's good to know that. Those are sort of the guideposts. And they've told us, they're not going to move until they're much more confident that we're going to get there. So I think that does help people navigate. It doesn't mean that we know for sure what the Fed's going to do because, as they say, it's conditional, right? It depends on how the economy is going to evolve. Nobody knows for sure what that's going to be, but I think it's helpful to have these guideposts.
Mm-hmm. I know you're an economist, and here Tyler and I are asking you stock market questions, but they're so connected that investors are really looking to see what's going on in the economy and vice versa. So stocks rose a little bit today. Gold was stronger. The dollar was gold was down. The dollar was stronger. So kind of what's next for the markets? Is it just going to be are they going to go higher from here? Are they going to be going lower, just sort of stuck in this same range? What do you think happens based on what Janet Yellen said today?
I think, based on what she said and what we've been talking about along, it depends. It really depends on how the economy evolves. I think the economy's got a good chance of continuing along its recovery path and actually doing a little bit better. I think the progress that we've been seeing towards full employment, towards price stability is likely to continue. But I think it's going to be gradual. I think that the Fed is certainly not going to be hurrying. They're going to keep policy accommodative still for quite a while. So I think on the whole that creates a pretty favorable backdrop for equity markets. But of course there are risks out there. There are global risks, to be sure. Though the data have looked a little bit better in the U.S., they look a little bit soggier in other parts of the world. So we have to keep an eye on that.
There were two dissenters today, two dissenters who will be leaving the voting rolls on the Open Market Committee next year. Has Janet Yellen proved that she is in charge of the Fed fully?
I think so. I mean, of course, it is a consensus-building institution, and you're never going to get everybody on the same page. People have different views of the way the world works. I think these dissenters, though, are kind of far from the center of gravity of the decision-making core of the Fed. So I don't think they really are reflective of where that core is. And I think Chair Yellen has done a pretty good job of guiding and leading that center of gravity.
Josh, always interesting to talk to you and hear what you have to say. Thank
Great
you so
to be
much.
Here.
Josh Feinman from Deutsche Asset and Wealth Management. Tyler?
Well, one of the sticking points for the Federal Reserve has been the inflation rate, which has been running below the central bank's long-run forecast. And today, more evidence of low inflation at the cash register. Consumer prices unexpectedly declined 0.2% in August. That's the first monthly drop in more than a year, with the price of gasoline, oil, clothing, and airline tickets all dropping last month.
Well, there are no inflation worries when it comes to online shopping. With more people than ever buying through the web, FedEx is doing more ground shipping to their homes and delivering more profits to investors. FedEx posted strong quarterly earnings today with net income up 24%. Shares rose more than 3%, and they're up 11% so far this year. So what's FedEx doing right? Morgan Brennan takes a look.
Profit at the world's #2 shipper jumped 24% from last year as sales increased in all of its major divisions, ground freight and express. Several factors played a role, including cost-cutting program and increased e-commerce shipments. The strong beat is a good sign for the economy since FedEx and its competitors are considered bellwethers of growth. And it comes on the heels of an announced 5% rate hike for all of the company's North American operations. That will begin right behind the holiday season on January 5th, the same day new dimensional rates tied to box size also take effect.
FedEx is now beginning to take a leadership position from a pricing standpoint. Typically, they don't increase their ground rates before UPS, but this year they moved it up 3 months and did so before UPS. And I think they're frankly becoming a little bit more of a leader in that respect because they did not have the service problems that UPS had last year.
The company says the increases are, quote, appropriate given current market conditions. Analysts expect the rates to stick because the number of packages being shipped is growing and capacity remains tight. But before those higher prices kick in, FedEx has something else to focus on first: the holidays. The company expects to set another record for peak season shipping volumes and is hiring more than 50,000 temporary workers to do so, more than double last year, though still far less than the 95,000 workers being brought on board by competitor UPS.
They did not have service problems around the holidays, despite the snow, despite the ice, and UPS did. And I know the weather was a factor, but the bottom line is the little ice and snow clouds did not follow around the UPS trucks and ignore the FedEx trucks. FedEx got it delivered over the holidays, and I think that's benefiting them in both volume and pricing power today.
That's why FedEx is reiterating an ambitious earnings forecast, setting up what many analysts believe could be a turnaround year. But this is all going to come down to several factors: fuel prices remaining relatively low, continued economic growth, and of course, the weather, especially as children once again make their wish lists for Santa. For Nightly Business Report, I'm Morgan Brennan in Fort Lee, New Jersey.
And FedEx isn't the only company announcing that it is taking on more seasonal hires for the upcoming holidays. Just today, Kohl's announced plans to add 67,000 holiday employees. That's up from 50,000 last year.
Turning now to international news, residents of Scotland will make an historic decision on independence tomorrow. If they vote yes, they'll break away from the United Kingdom after more than 300 years. But right now, polls show the no's are in the lead, but not by much. And understandably, a lot of businesses are nervous about what happens next. Michelle Caruso-Cabrera is in Edinburgh, Scotland, with more.
The feelings are intense on both sides of the issue, and so is the campaigning. The nearly 5 million Scottish voters remain deeply divided on whether or not to become independent from England.
I'll be voting no.
You'll be voting no?
I'm sure there's lies being told on both sides, but so if you can't make up your mind, you've got to go with what you've already got.
I'm voting yes.
You're voting yes?
Yes.
Why?
Because I think we're better when we can control our politicians where we can see them, that's why.
You're not worried about the pound and
absolutely
all that stuff?
not. It's our pound because we can still use it.
The Yes campaign says the Scots should have more say on how their tax money is spent, and they'd like to spend more on social welfare programs. The No campaign says the Scots face economic risk. They could lose the backing of the English central bank and perhaps their membership in the European Union. That would hurt trade. One of Scotland's largest industries is Scotch whisky, and its members are worried about the potential loss of access to the European Union trading bloc. Scotch is a huge export for Scotland, $6.5 billion last year, or 95 million cases.
This is the factory floor of the Ian MacLeod distillery in the heart of Scotland. The finance director here tells us that if the Scots do vote for independence, he thinks it will be very detrimental to the business. The hat, by the way, required by hygiene regulations.
I'm nervous because the result could be quite difficult for business.
He fears losing the use of the British pound and that interest rates may go up.
So many things at the moment are not clear at all, particularly in terms of obviously currency and for our industry access to markets.
Graham Blackett is an economist and businessman who supports independence. He knows there are risks, but he says the key issues can be resolved in the negotiations that will come after the vote. Ultimately, he thinks it's better to have a government right in Scotland rather than as far away as London.
I live close to where a guy called Hugh McDermott, who was a famous Scottish poet, used to live. And he had this phrase that said a parliament should always be within marching distance of the people.
That way, he says, Scottish businesses can have more influence on what matters to them. As for now, it's the voters who have all the influence. For Nightly Business Report, Michelle Caruso-Cabrera, Edinburgh, Scotland.
Still ahead, what a difference a year makes. Remember the government shutdown about a year ago? Why members of Congress are taking a very different tack this year.
Higher reward money for Wall Street whistleblowers. That's what U.S. Attorney General Eric Holder is proposing. In a speech today at New York University, Holder asked Congress to raise the limit on the amount of money whistleblowers may receive for providing evidence of financial fraud or other misconduct, something Holder says is needed more than ever to combat wrongdoing.
But it remains true that at some institutions that engaged in inappropriate conduct before, and may yet again, the buck still stops nowhere. Nowhere. Responsibility remains so diffuse, and top executives so insulated that any misconduct could again be considered more a symptom of the institution's culture than a result of the willful actions of any single individual.
Current laws cap those rewards at $1.5 million, which Holder called a paltry sum and may not be enough to entice the cooperation of many in the financial industry.
Well, more out of Washington, and this time it looks like Democratic and Republican lawmakers may be on the same page, with the House voting on a bill to fund the government into the next fiscal year, beginning October 1. But there's a lot more than keeping Washington lights on in this congressional resolution, and here to tell us about it is John Harwood from the nation's capital. John, does the House vote today mean that government will stay open next month? Congress will avoid a shutdown, and what does the election have to do with all this?
It means they'll avoid a shutdown at least through December, Tyler. That's when this continuing resolution extends government funding until. And you're right, this was a bipartisan vote, overwhelming. The House cast more than 300 votes in favor of this, a majority of both Democrats and Republicans voting yes. They want to clear this issue off the table and get back home and campaign in midterm elections.
John, to what extent did the debate change because of that amendment of President Obama on his new offensive against ISIS? Is there any connection between the two?
Well, that served, Susie, to try to enhance the bipartisan feeling behind this bill. Republicans already wanted to avoid a government shutdown. They don't want to make themselves the issue in the midterms. They want to make Democrats and President Obama the issue, so it was likely to go anyway. But the fact that the nation is rallying to some degree behind the president's new offensive against ISIS, and Republicans and Democrats on the Hill are rallying, served to add a bipartisan element that made it all the more certain this was going to go through. Now the Senate has to follow suit.
And the Senate presumably will. Any provisions of special interest or importance to business in this resolution?
Yes, there was. The extension of the Export-Import Bank funding through next June, and the authorization for the Export-Import Bank. Remember, that was in danger because some Tea Party Republicans argued that this was crony capitalism benefiting large companies like Boeing with their overseas deals. Now you have tremendous business support for this and bipartisan support through this bill to extend that funding into June. Still going to be a challenge to have a long-term extension, but at least for now, the fear that the Export-Import Bank will go away is off the table.
All right, John Harwood, thanks very much, John, reporting from Washington. Well, everyone seems to love a happy home builder, and today we got a lot of them. Home builder sentiment this month shot up to a fresh 9-year high since before the housing collapse as builders continue to sell more newly built homes at higher prices. That's a recipe for happiness. Here are the shares of some of the nation's biggest home builders, how they ended the day's session. KB Homes up more than 4%, D.R. Horton up 3%, Toll Brothers and Ryland Group also in the green.
And the biggest gains of all today went to Lennar. That's after the home builder said its latest quarterly earnings went through the roof. Profits surged 47% as it sold more homes and apartment buildings at higher prices. Shares of Lennar shot up almost 6% to $41.40.
An activist is calling for DuPont to split into two, and that is where we begin tonight's market focus. Nelson Peltz's Trian Fund Management says the chemical company should be broken up. His firm sent a letter to DuPont's board saying DuPont's current structure is destroying shareholder value. It suggests creating one public company of its faster-growing segments and another with its operations that generate strong cash flow. Shares popped more than 5% to 69.25. General Mills posted results that missed on the top and bottom lines as cheaper store-branded foods are eating its profits. The Cheerios cereal maker blamed challenging market conditions in the U.S. for the miss. Also, the company announced $100 million in new cost cuts. Shares tumbled about 4.5% to finish at $50.83. And Microsoft hiked its dividend by 11% to 31 cents, but that's the smallest percentage increase in the payout since 2009. Also, the company appointed new directors to replace 2 board members who decided not to seek re-election. Shares of Microsoft down a little bit to $46.52. And a warning from Sony sent its shares lower. The company says it will report a much larger than expected loss of more than $2 billion for the fiscal year, and it will not pay a dividend for the first time in more than 50 years. It cited a struggling smartphone business for the revision. The stock off almost 7% to $18.88.
Cracker Barrel saw its fourth quarter profits rise as higher prices and cost cuts helped the restaurant chain offset lower traffic. Those results beat estimates, but its profit outlook for the new fiscal year came in below consensus. Shares fell by 2% to $101.07. U.S. Steel says it expects third quarter results to top estimates. Also, the steelmaker's Canadian unit will apply for protection from creditors as it looks at restructuring alternatives. U.S. Steel also said it won't proceed with planned investments and expansions at its plants in Minnesota and Indiana. And the stock surged on all that news 10% to $45.61. We have another update in that dollar store saga. Family Dollar has told shareholders to reject the unsolicited $9 billion takeover bid from its rival Dollar General. Family Dollar is trying to arrange a sale with the other chain, Dollar Tree. Shares of both store operators off a bit. And United Natural Foods posted strong results after the bell. The natural and organic food distributor also gave investors guidance that topped Wall Street estimates. Shares soared initially after hours, but during the regular trading day, the stock was up only slightly to $63.61.
Right now, the National Football League is suffering through perhaps its biggest crisis ever, and big consumer brands that pay millions to sponsor the league and its athletes are speaking out about how officials are handling or mishandling domestic violence issues. Julia Borston has the story.
Nike suspending its contract with Adrian Peterson after his indictment for child abuse, saying, quote, Nike in no way condones child abuse or domestic violence of any kind. This after the NFL's response to Peterson and Ray Rice's domestic abuse scandal prompted mega sponsor Budweiser to warn, quote, we are not yet satisfied with the league's handling of behaviors that so clearly go against our own company culture and moral code. We have shared our concerns and expectations with the league.
They're concerned about their stakeholders. They're concerned about their stock price. They're concerned about a lot of things that are external to the game of football, quite frankly, and those things are business.
Anheuser-Busch spends about $200 million annually on NFL rights, fees, and ads, paying for Bud Light to be the league's official beer. It's just one of many big brands speaking out. Visa, McDonald's, Pepsi, and Verizon among many commenting on the seriousness of domestic abuse and the importance of the NFL doing the right thing. The NFL's biggest games deliver TV's highest ratings and the most expensive advertising. But will brands actually pull the plug on the chance to reach such a massive audience?
There's a very good chance that sponsors will pull the plug on advertising dollars, not just with individual athletes, not just with teams, but potentially bigger contracts with the league if things get worse.
Now there's more money on the line than ever.
You know, $8 billion a year in television revenues. And why do the TV networks pay those rights fees? Because they know they can get it back in droves from corporate sponsors. So this is a watershed moment for the NFL.
According to YouGov Brand Index, the NFL's consumer perception has dropped to its lowest point since 2012, when former players filed a class action lawsuit over concussions and brain injuries. For Nightly Business Report, I'm Julia Borston in Los Angeles.
And coming up, the end of higher education as we know it. Will half of the country's colleges and universities no longer exist years from now? We have the final part of our series, The Future of Education, next. A warning today about the safety of personal data kept on file on the healthcare.gov website. Government watchdog, the General Accounting Office, says it's found security and privacy vulnerabilities on the federal exchange. And that's despite steps taken to enhance the protection of customer data in the past year. There are still weaknesses in keeping that information safe.
And finally tonight, what might a college education look like 25 years from now? What will the student body look like? And what could be the impact of rising tuition costs and the current student loan bubble? In the final installment of our three-part series on the future of education, Sharon Epperson gives us a glimpse on the changing landscape of higher education.
In 25 years, the higher education landscape may be unrecognizable.
Half of the colleges and universities that now exist in the United States will cease to exist.
Technology responsible for the shift is already underway, as some of the nation's top universities, including Harvard and MIT, have started to open up their classes to the world for free through massive open online courses known as MOOCs.
A MOOC is a free education course offered online that anywhere from hundreds to thousands of students can sign up for.
The ability to receive a highly coveted elite education for free will have significant implications.
Your local state university is going to be in direct competition with the most elite universities in the world.
Futurists say big-name universities with strong private endowments should be fine. Low-cost community colleges will be okay too. But those schools that are largely dependent on tuition may struggle and may not survive.
The universities that are in trouble are those that are, if you will, stuck in the middle. And we're seeing this, we call it the hollowing out of the middle. We're seeing this in industry after industry. Those who are kind of caught in between those two will either adapt or face the consequences.
When the middle hollows out and mid-tier colleges and universities go out of business, many futurists say higher education will become much more personalized.
You might take a law class from Harvard, you might take an engineering class from Purdue, you might take an economics class from MIT, and you have the option then to sort of curate your own education.
It's not all doom and gloom.
It's a positive story that represents a whole new level of access for students and opportunities for people who couldn't afford it otherwise.
For Nightly Business Report, I'm Sharon Epperson.
Fascinating changes here. It's going to change the whole business model of higher education, in my view, the online
And hopefully
aspect.
we get a lot smarter students because they'll have access to the Harvards and MITs of the world, right?
Yep.
That's Nightly Business Report for tonight. I'm Susie Garrett. Thanks for watching.
And thanks from me as well. Tyler Matheson here. Have a great evening, everybody. We'll hope to see you right back here tomorrow night.
And you really I'm Susie Garrett with the Nightly Business Report News Brief. Federal Reserve policymakers decided today to keep interest rates right where they are, near zero, for what it calls a considerable time. And that lifted the blue chip Dow average to a new record high. The Dow rose 25 points, the Nasdaq was up 9, and the S&P added 2 points, pulling back from its own record high. Big gains today for shares of home builders after home builder sentiment surged to a 9-year high, with more homes being sold at higher prices. Consumer prices declined in August, the first monthly drop in more than a year, led by a dip in gasoline and oil prices. And more online shopping helped FedEx quarterly profits soar 24% as the shipper announces plans to add 50,000 seasonal workers. Be sure to tune in to Nightly Business Report right here on your public television station.